you know, bubbles, bubbles actually are very common. They're far more common than we think they are. And they occur in all kinds of different asset classes. They occur in all kinds of different geographies, in all kinds of different markets and such at different times. They're kind of staggered all over the place. And there was a book written by a former news anchor for CNBC, Ron Insana. And normally news anchors don't write good books, but Ron Insana wrote a book called Trend Watching, uh, which um, which listed a number of different bubbles. And if you just go through the book, you'll see that almost all the time, somewhere around the world, there's some bubble in very much in the works or in progress or getting burst and so on. And so they're very common phenomena, partially because humans vacillate between fear and greed. And as long as we have humans involved with markets, we're going to have bubbles. And so I want to just highlight a few bubbles in the past and also a little bit about the present. So in uh, in the early 1920s, really like 1919 to 1922, we had a very major automobile bubble, and it burst in a pretty significant way in 1922, but then the remnants were all taken out in the next 9 or 10 years. And so if you looked at the U.S. kind of from a investor or entrepreneur point of view, and you were in the year, let's say 1920 or 1921, so World War One has ended. A lot of the world infrastructure, especially in the developed world, is destroyed, except North America is untouched. Europe is pretty much in flames, and the U.S. is industrializing. It is the emerging market, and you can clearly see that the all the trends are in the right direction. The population is growing. Highways and roads are getting built at a very prolific rate, and automobile sales are forecasted to grow quite significantly. I mean, if you look at what actually happened, let's say between 1921 and 1922, auto sales went up by 50%. And that is, rivaling what was happening a few years ago in China on auto sales. So the U.S. was truly an emerging market, and these were the go-go 20s. Everything looked like it would go nothing but go straight up, and investors basically you know had certain perspectives. One is they expected that the U.S. population would rise. In 1921, the U.S. population was 109 million, and they were absolutely correct that the population rose nonstop for the next 94 years. And even now, when we're at 300 odd million, it's going to continue growing for as far as we can see, just the way the demographics of the country are. So they were absolutely right that you had a very long tailwind of population growth. Uh, Investors also expected that the country would industrialize. Uh, when the United States was formed, something like 97, 98% of the population then was focused on farming, and that number had been continuously coming down, and until the Industrial Revolution, and then it was coming down quite radically. So people could see that the country, as it industrialized, autos would grow big time, and they were absolutely right. The 1.5 to 2.5 million number. Now this year we're forecasted to have more than 18 million cars sold in the U.S. So all these things were correct, but nearly all the 1921 investors in autos or motor companies lost their entire investment, and this was a very major bubble at the time. And if you go through some of the next few slides that are coming up, this is a list of all these different car companies, and next to their names is their year of birth and year of death. So like, you have like the Stanley Steamer 1897 to 1927, or you have this Lafayette from 1919 to 1924. So that car company lasted 5 years. And so we had hundreds of auto manufacturers uh, come up with a variety of wide range of cars, and lots of money went into these ventures. And in the end, by the time the dust settled in 1932, we were left with three major U.S. manufacturers for cars, and almost everyone else was wiped out. And so this was a very significant bubble that took place. And basically, it wasn't just investors. I mean, a lot of entrepreneurs bought into this, and uh, a lot of these companies went public, and then they went bust after going public. So we had a very significant bubble nearly about a century ago, at about 93 or 94 years ago. And then if you look at the 1959 to 62 period, we had another very significant bubble, and this is called the Tronics bubble. And what was happening at this time was that um, you had the semiconductor that had been the transistor had been invented, semiconductors had been discovered, Moore's law was coming into play, and people expected that electronics would be a major game changer. It would reconfigure a wide range of industries, and they're absolutely right, because Moore's law has basically where you're doubling the amount of transistors in the same amount of area every couple of years or every 18 months has pretty much been the case almost nonstop from then till now. I think now Moore's law is down to every 2 or 3 years, but we're still seeing that trend play out. And so as a result of that, we've had the huge growth in computers, going from mainframes to minis to servers to PCs to laptops. Then we had all the cell phones and iPhones and iPads, and pretty much, you look at it basically. 60, 65 years, 66 years, electronics has grown nonstop. And so the investors were correct in 1959 that electronics was a sunrise industry and it would change lives big time. But in spite of being correct, just like the people in the motors were correct about the trends, they lost their entire investment. And in fact, what happened in the early 60s is all these companies came public with the name ending in Tron, like Astron, Dutron, Vulcatron, Transitron, or they had Onyx, like Circuitronics, Supronics, Videotronics, and the ultimate was one with both, Powertron, Ultrasonics. And they wanted to make sure that when they had an IPO, they had sizzle in that name, and that was a very sizzling name. And I'm sure people bought into the Powertron Ultrasonics, and it all went to zero. So that also did not go very well for investors, even though they were absolutely right about the major trends, and absolutely right about the huge transformational impact that the semiconductor and transistor would have and continues to have. And and then if you look at some of you are probably too young, uh, and but I certainly lived through this, and I think Arvind also was. Arvind, how old were you in the year 2000?
You're putting me on the spot, Manish.
Yeah, how old were you in the year 2000?
I was in college.
All right, in college. So we had got like an 8-year range or something, 6-year range. Okay. So Arvind very much remembers the .com bubble, and I think many of you in the room, if you're in your mid 20s or so on, So this would have been what, about when you were about 10 years old or something. Maybe some of you were teenagers then. Um, but anyway, so I was actually an investor then and lived through this as well. So we had the dot-com bubble, and again, the investor expectations were that the internet was a game changer. It was a massive disruptor, and they were right. It has improved our lives big time, and the economy would get reconfigured. And they were absolutely right. We are still going through that reconfiguration, and it's very significant reconfiguration. But nearly all 1999 investors in dot coms lost their entire investment. It didn't go so well. And if you look at some of the names, like Boo.com, they spent 188 million in the first 6 months. Cosmo, which is no relation to Kramer, was trying to do 1 hour deliveries, and so on. We had a long list of companies that basically went under. And here's a list of some of these companies which were bought. And so if you look at, for example, something like Broadcast.com, which was sold by Mark Cuban uh, to Yahoo for 5.7 billion. And Cuban was pretty smart. What he did is, when Yahoo gave him Chinese money, also known as Yahoo stock, for broadcast.com, he negotiated and hedged the entire position. And so after that, when Yahoo stock crashed and burned, Cuban was mostly unaffected, and hence we see him on Shark Tank now. And and actually, if you look at Mark Cuban's present net worth, I was just looking at it in the Forbes 400 recently. It's actually less than 5.7 billion. If I remember, it's like 2 or 3 billion now. So from that time till now, he's done all these different things, bought the NBA team, made a bunch of other investments, and so on. But his net worth really hasn't done much. I think the single best decision he made was to hedge that Yahoo stock, and everything else is wonderful. And then you even see IAC Interactive buying Ask.com for 1.9 billion, and you look at some of these other deals that Yahoo has done. GeoCities for 3.6 billion, and you look at the state of Yahoo today and all the talk about now selling the company. And so this uh, there was a lot of euphoria at the time. And in fact, in the year 2000, in January, I was on the HBS campus, and I used to come to the Harvard Business School every year for a week as part of this executive ed program, where we do kind of like a week of MBA school uh, through YPO. And there were about 160 of us every year for a week, and the average person ran a $400 million company. And I did this 13 years, from 1999 till last year. And one evening we would hang out with the MBA students. So there would be 8 YPOers and 8 Harvard MBA students, and we'd go out for dinner. And basically we'd sit, YPO or MBA, YPO or MBA. So on both sides of me, for example, were 2 MBA students. And I remember in that year, in January 2000, the bubble was fully on. I mean, it was just full on at that time. It popped. It popped in March, and all these kids basically had mostly already formed companies. Some were dropping out of HBS. They didn't want to wait to complete their degrees. They were getting venture funding. Some of these companies coming out of the HBS campus had, I would say, pre-money or post-money valuations, which were in the hundreds of millions. And so these guys were on top of the world, if you will. And that year, when they went to dinner with us, the the body language was that they really felt like they were wasting their time with a bunch of these old guys who just didn't get it about the internet, didn't get it about the way the world was being reconfigured and all of this. And they were all talking about that, in 2 years they were all going to be billionaires. And then, a couple of years later, again on the HBS campus, again going to dinner with the MBAs, and the economy is in a kind of recession and so on, and the I would say the body language is very different. They were giving business cards. They were asking if they could get internships, and so on and so forth. So the life and times changed pretty fast. And what you had going on was that like there was a chemical, um, Chemdex was formed then, which was like supposed to be like this uh, marketplace for industrial chemicals. And so there were all these other dexes being formed on HBS on the Harvard campus with like looking at other aspects of industrial materials. There was the metals exchange. There was all kinds of stuff going on, paper exchange, and so on and so forth. So there was, and if you just think about the, and then all the squatters trying to, which still goes on today, trying to get the name and sell it for a zillion dollars and so on. So fun times. Anyway, so if you look at these three bubbles, the three bubbles are very similar to each other. The motors bubble, the tronics bubble, and the dot-com bubble, each of them is about 38 to 40 years apart. And the 38 to 40 years apart is not a coincidence. The reason they're that far apart is because the set of investors that saw this bubble have to have exited the scene before the next bubble can take place, because then there's nobody to tell them that, hey guys, you guys are smoking dope. This we've seen this movie before. And I remember that when the internet bubble was going on, Buffett would talk a little bit at that time about the motors and the tronics bubble, but he was just drowned out. In fact, most of the talk at that time was, kind of like, what's wrong with you, Warren? You're not in these stocks, and Berkshire stock has dropped a lot, and so on and so forth. Uh, so, I would not be surprised if the next one is in kind of the 2036 to 2042 range. And who knows what the theme is going to be then. It could be transport companies taking people to Mars. We don't know what the and if it is something like that, transport to the moon or transport to Mars, then all the investors at the time are going to look at these previous three bubbles and not see any similarity between these three and that one, because they're going to say, well, this time it's different. The last one is different, but we're getting a whole new planet. So we got a different set of things to worry about. So most of you will very much be, I guess 40 something when the next one comes around, and you will know, and you will know how to sidestep it, or like Mark Cuban, hedge the hell out of it. So and just to continue this discussion a little bit more, like I said, bubbles are very common. They don't just happen every 40 years. They're happening all the time. So in the early 70s, there was this notion called Nifty 50, where these banks and trust companies had come up with the idea that, you just buy great businesses at any price, and then you hold them forever. And if you do that, you end up doing really well. And there were these 50 blue chip companies like Disney, McDonald's, Coca-Cola, Kmart, Xerox, Digital, Avon, and so on. And since everyone wanted to buy these stocks and hold them forever, they went up to ridiculous multiples. So if you looked at the PEs in 1972, like McDonald's was at 86 times earnings, and Disney was at 82 times earnings, and Polaroid was at 91 times earnings, and so on and so forth. So these things really became very popular, and so the market basically was a bipolar market. You had very high valuations on these top 50, and then you had kind of the rest of the market kind of getting ignored. And and then we had the crash of 1973, 74, and uh, of course in 73, 74, what happened is that we had the Arab oil embargo. We had for the first time in the United States uh, rationing of gasoline and long lines at the pump, and people not able to get gas, and we had a president who had imposed price controls, and we had the impeachment of a U.S. president for the very first time. And so you had a whole bunch of different factors coming in, and in fact, what happened to the Nifty 50, and in fact, the crash of 73, 74 was actually worse than the 1929 crash, because the 1929 crash took place over a short period of time. This was a very slow motion crash. It took place over 2 years. But if you look at the end to end drop from top of 73 to the bottom of 74, it was a huge, I would say something more than, I think, a 60% drop in stock prices over that period. And so the Nifty 50 initially, people followed the advice, which is you hold these stocks forever. So all these earth-shaking events were taking place, and the market started dropping, but the Nifty 50 stayed intact because people kept with it. And then as the bad news just kept coming in, the Nifty 50 was taken out back and shot one by one, in the words of a Forbes columnist. And so you saw, 90%, 80% drop in prices of these blue chips like Disney and Coke and so on. And so that was pretty brutal. So the Nifty 50 didn't work out so well. And if you look at things today, so in my opinion, we have another Nifty 50 going on today, and it's more amongst a sliver of the tech space, where you have, I think Amazon's it's more than 576 times earnings now. It might be more than 600 or 700 times earnings. And then you have Netflix, I think also north of 200 times earnings. Twitter, Facebook, Tesla doesn't make money. If they made money, they'd be at over 100 times. SolarCity would be at 250 times. And Uber, with the whatever 50 billion last round or so. In fact, interesting thing about Uber is its valuation is 1/6 of Amazon, and so if you thought Amazon is a fair value, then one would question whether 1/6 is the correct number for Uber. But basically, investors aren't focused right now on the valuations. What they're focused on is they believe that these businesses will be transformational long term in terms of how we conduct our lives, and they'll be very much very central to our lives, and therefore they're interested in going into these spaces. And of course, one of the ways that bubbles get going is that when people start seeing prices go up, they feel like they're left out, and they want to join that party before kind of the train leaves the station. And I remember I was in 2000, I was living in Chicago, and I think it was late '99, early 2000. I was in downtown Chicago, and I got into a cab, and a lot of the cab drivers were Indian and Pakistani in Chicago at the time. So this Pakistani cab driver, he noticed that I probably was from India or Pakistan, and he says to me in Urdu, uh, आपका Cisco के बारे में क्या ख्याल है? And for the sliver of you that didn't understand that, what he was saying is that what are your thoughts on Cisco as a stock? And so, when the cab driver is focused on high speed data networking stocks in the year 2000, you know that it's like the shoeshine boy in 1929 giving you stock tips. And of course, Cisco never saw that market cap again. They were at 600 billion at the time, and they'd never seen that again. So, these companies, and we have a polarization going on, just like Nifty 50 right now, where you have these sliver of these tech stocks that are valued very richly, and then even the older techs, once you get to things like Oracle or Microsoft or any of these other companies, they have very even Apple and Google, etc., have very sedate valuations. And then when you get to kind of old economy stocks today, like if you look at the banks, or you look at you know normal manufacturing company, etc. Again, you might even say they're undervalued, because what happens when you have these bubbles is the money is being flushed into one particular area. And of course, right now, one of the issues that investors face is on the fixed income side, there's no money to be made. So investors would normally be in fixed income are very frustrated, and then they see these kind of high flyers. So I suspect some of that fixed income money is heading this way, which is a huge amount. And I also suspect that money that would normally go in the rest of the stock market is being kind of disproportionately funneled this way. And so so basically, if you look at something like, just look at Tesla, for example. So they have I don't know, like a 30, I think the market cap is about 30 billion now. They have a 4 billion revenue run rate. They're losing about 400 million a year. And you can argue that a business like Airbnb or Uber is a capital light business. It's a tech business. Tesla is a manufacturing operation, with its manufacturing in one of the relatively higher uh, labor cost areas of the planet. And if they want to grow, they have some very, very significant capex. And so one could argue that an Airbnb or something, which is capex light, deserves a richer valuation than a Tesla, which would, if they try to increase from 50,000 cars a year to 200,000 cars a year, for example, it would be a massive, massive, I mean, tens of billions in capex to get there. So uh, so even if they made an 8% profit, the PE would be over 100, and the best car companies make about 7%. So just to give you a sense, and then just to see how the money is moving from old economy to new economy. We have General Motors, which has actually a market cap, if you take out their cash, at a little less than Tesla. And Tesla makes, like I said, about 50,000, actually less than 50,000 cars a year. uh, GM has nearly 10% of the global auto market, making about 9 or 10 million cars a year. So it's a rounding error for GM in terms of what Tesla makes. And they're the number one car company in the US and China. I mean, one in 5.5 cars sold in the US is a GM car. And similarly in China, they're number one. And they make over 10 billion in cash flow that's heading to 12 or 13 billion, aggressively buying back stock, NOLs shielding most income. And people get excited about Tesla for the electric car. GM's got the Chevy Bolt coming out next year. It has a 200-mile range, pure electric, $30,000. And Tesla would not have a car equivalent to this till at least 2018. So GM's actually 2 years ahead on this, but because it has the name General Motors, nobody cares. And so you just see this kind of huge divergence in these valuations between kind of old and new economy. And you can also see it when you look at something like Netflix and Micron Technology. So this is a quote I took from David Einhorn's second quarter letter to partners without talking to David. So I hope he doesn't object. But he says our long-term outlook is that sometime in the next few years, Micron Technology, currently valued at 20 billion, with 3.7 billion in trailing net income, will be worth more than Netflix, currently valued at 40 billion, with 240 million of trailing net income. And of course, Netflix now is at 44 billion, and Micron is at like 15 billion. And if you ask Reed Hastings, the CEO of Netflix, about the stock price, his answer is, to me, he does not understand why Netflix stock is trading where it's trading. And the second thing to understand about Netflix is, while they have a little bit of their own content, more than 99% of what they're pumping through is other people's content. And other people's content is subject to inflation and subject to all sorts of other factors, because content is king. So Netflix has, even if you grant them that they have the pipe, what goes through the pipe has to be paid for by them to these content owners who aren't exactly, I mean, you've seen that even in the cable business, the content owners versus the pipe owners, you constantly have this struggle. And so when Netflix is charging $8 to me to come into my living room with unlimited content, and they have to on the back end pay for that content, um, you know, it's not a business model where you can say out of the $8, $7 is profit. That's just not the economics. And then of course you've got all the technology costs and all the bandwidth costs, where uh, some of the internet service providers are complaining about the the bandwidth and so on, and the usage. Um, so again, Netflix is a fantastic business, extremely well run business. All of us love it. We get a lot of value out of it, but none of that means that the stock is going to be a winner. And another way to think about this is to invert, is to use Charlie Munger's inversion logic. Charlie Munger says you can solve many problems by inversion. So if you invert, so let's take something like Amazon, which I love. Probably spend too much money every month on Amazon, but Amazon has a market cap of, I think, 320 or 330 billion or something today. So if you were an investor today in Amazon, uh, it would mean that you're expecting that market cap to go up from today, because otherwise, why else would you put money into Amazon unless you were expecting robust growth from year out? And let's say if you were an investor with uh, somewhat modest uh, expectations of, let's say, maybe 15% or 20% a year, if you owned Amazon. Well, if you had a 15% expectation, then what your expectation would be that every 5 years the stock would double. And so over the next 20 years or something, Amazon would need to be 600 to about 2.4 trillion, 600 million after 5 years. No, actually more than that. 1.2 trillion after 10 years, 2.4 trillion after 20 years. Yeah, so it'd be about 5 trillion in 20 years. And if you think about the entire wealth of the planet, so first of all, the entire US stock market cap, all stocks, including Amazon, today is about 20 trillion. And so you're expecting that the rest of the pie would not grow so much, and the one company would be, I don't know, 10 or 20% of the US economy. And global wealth currently is close to about 100 trillion. And again, look at the percentage versus uh, global wealth. and global wealth is not going to grow from 100 trillion at 15 or 20%. It might grow at 1 or 2% a year or something. So when you do the math, the law of large numbers kicks in, and so count me as a skeptic on the 5 trillion valuation of Amazon in 20 years. So inversion is a good way to solve uh, some of these issues. And then we have this chart which shows the number of public companies, the PE over 100. And in 2000, we had over 100 of them, and now we have about 80 of them. This is that whole Nifty 50 of 2015, where most of those 80 companies are these, Amazon type high flyers. And anytime you've gotten high up there, you've seen that you've kind of come back down, and that may be another data point to look at. And so, on March 10th, 2000, which is the day the Nasdaq peaked, Berkshire Hathaway hit a multi-year low of 41,000. Its price was cut in half from 1998. And in fact, what was happening is that exactly that. The money was going from people selling Berkshire to buying all these different new economy stocks. And of course, I started Pabrai funds in '99, and we didn't have any of the high flyers in our name, and we did very well actually in the first year of the funds, including past the bubble being burst. We were up 70% because we were buying these companies that were very cheap because no one was interested, and such. And when the bubble burst, we really had no impact on what Pabrai Funds was doing. And so if you look at the Nasdaq Composite, this is a index which is made up of 2,200 stocks. The total value of the index is 7 trillion, and the total value in 2002 and 2009 was about 2 trillion. And you know, if you mute, I think Arvind, if you mute, we'll get a better audio. So I've muted you. So I'll unmute you later. So anyway, we've got 2 trillion in valuation in 2002 and 2009. Currently, the top 10 businesses in the Nasdaq Composite make up 2 trillion. So the top 10 make up 31%, and the top 100 make up 5 trillion. And amongst the top 100, you have the Facebooks and the Amazons and all of that. And so you have 2,100 stocks that are worth about 2 trillion, and you have 100 names that are worth 100 that are worth 5 trillion. And one more thing I'd like to just point out, the Nifty 50 in 73, 74 had some tech names. They had Xerox, Polaroid, Kodak, Digital, IBM, and so on. And with the sole exception of IBM, all the tech component of the Nifty 50 pretty much disappeared. I mean, almost all the value was lost. And that is because, like Buffett says, rapidly changing business industries are the enemy of the investor. And so the ones that have stayed, even though they didn't deliver a good return, have been the non-techs, the kind of the Coca-Colas and Disneys and such of the world. They have endured. And today, when you look at the Nifty 50, it is all tech, and it is all in areas of rapid change. And so it is questionable whether the 1972 Nifty 50, it's 43 years since that peak of the Nifty 50, and Coke is still with us, and Disney is still with us, and so on. Many of them have made it through, but if you look 43 years from now, which is would be 2000, what would be 43 years? So 2068, I think. Yeah. So 2068. If I were a betting man, I wouldn't bet that in 2068 uh, we have Netflix around. I mean that'd be a pretty tall order to make that bet, just because of the reconfigurations and such that take place. So that's the second piece of the difference between, the other thing about these two. So the first set of bubbles we saw were 40 years apart, approximately 38 to 40 years apart. The Nifty 50, the last Nifty 50 and the current one is 43 years apart. So you're seeing about this, let's say 37 to 43 year between these mega bubbles. And it's again the same thing, which is none of the investors who are coming into Amazon and Uber and all that today have any memory of the 1973-74 Nifty 50. Never lived through it, don't even see the parallels. And, you know, my lone voice in this will just get drowned out. So no one's going to care about what I'm trying to say here. And that's just the nature of things. Um, and so then we get to uh, the Nasdaq Composite. Of course, went from 5,000 to 1,200. The current situation is not as extreme as 2000. That was a very extreme situation, and it's hard to predict what happens. It could flatline for a long time, or it could correct in a short period, or anything in between. But the best advice I could give is just to stay away from the high flyers. Look at other places. And we are seeing a little bit of different situation play out. So in what happened to the Nifty 50 in 73, 74, we had these kind of huge macro events take place, like the oil embargo, the big lines outside gas stations, the price controls, huge inflation, impeachment of a president, the Vietnam War. A lot of things are going on. What is happening right now is it's happening kind of quietly, and I think they're being taken out back and shot, but they're taken out back and shot one by one. So I don't have a slide on GoPro, which I love as a camera. I'm sure many of you have a GoPro camera. Look at the stock chart on that, and when you look at that peak valuation on GoPro, what are people thinking? Yeah, it's a nifty camera, but what would it take to one up GoPro? And what is the situation with GoPro in 2068? It's not going to be around. I mean, there's no chance. So what we are seeing is like, we are seeing the shakeouts happen one at a time. Like the MySpaces of the world are gone. Twitter's now at 40% less than peak valuation. Living Social, which was like Groupon, had a $4.5 billion valuation at the last round. They were going to go public. They never went public. They've gone from 4,500 to 800 employees, and they're burning cash. Square IPO at less than 50% of the value of the last venture round, which is very unusual. And these unicorns that people talk about, which is private companies with over $1 billion valuation, there are 141 unicorns currently with a combined value of 500 billion. Many are going to be real businesses for a long time, but I wouldn't expect for most of them to deliver the goods for investors. And I think with that, we're at the end.